Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. We have Brian Sozzi on the line, noted retail analyst, and he's going to comment on his move in Sears. Brian, how you doing?
Well, I'm doing well. Do I have to comment on this?
Yeah, come on. We know you're dying to give us your outlook on this. The shares are marching ahead. What do you think here?
Well, the market is what the market is doing today is valuing Sears not as a retailer, but as some form of zombie REIT that manages their property and collects fees from other retailers. Because I think when you cut right to the heart of the matter, the company's retail operations, and to me, the company's still a retailer, remains in shambles. The sales in the third quarter, which they pre-announced today, were negative. And what really struck me is if you scroll down to the bottom of the SEC filing, the net loss, the unadjusted net loss, the GAAP loss that we're all trained in high school and college to follow was worse than it was last year. And then secondarily, the company's cash burn was quicker at this time this year ahead of the holiday season compared to this time last year ahead of last year's holiday season. And for me, that's very disturbing.
So in other words, if I'm getting your assessment right, okay, they're going to convert to a REIT, okay, they're going to try and pull the value out, and they're going to lease it back to themselves, and what you're saying is there might not be anything to actually lease if the stores are going out of business, right?
Well, the stores, I think what you see today just forestalls the inevitable. May I keep in mind today, to remind everybody that they didn't come out today and announce that they secured XYZ millions or close to $1 billion in cash. This is just them signaling to the stock market that they could, or they have the potential to raise money via this new REIT form. And if they didn't come out and signal to the stock market, and I think you would have the market looking at a retail operation business that is just not generating cash and remains in a very worrying fundamental state. So coming into the holiday season, the market was concerned that Sears would not be able to survive 2015. It looks like they've pulled that off the table. For me, I don't want any exposure to Sears no matter what they're doing, no matter how much cash they raise. I'd rather focus on other areas in retail or stay the heck out of the sector altogether.
Yeah, okay. Also, some news coming out of Abercrombie and Fitch. Bad news for that company as well. I mean, you talk about avoiding the sector. Is there any chance that this company can rebound?
Well, with Abercrombie Fitch, we had specific concern over the past couple weeks that this warning was in the works. When you go into the stores, our senses was that the discounting picked up in the last couple weeks towards the end of the quarter. And what I think Abercrombie's release highlights is things we're now starting to see increasingly from Zara, Forever 21, and H&M. Those companies seem to be getting quicker in bringing more interesting-looking products to the sales floor than they ever have before. Very, very quick. And Abercrombie, American Eagle, Aeropostale, they just can't do things as fast as some of these fast fashion retailers. So again, I think in specialty retail, that's another sector you just want to stay out of. And the only name that we were somewhat optimistic on for the holiday season would be something like a Nike, something like an Under Armour, where they have a chance in hell of selling things at full price in a mall that's battling very weak levels of traffic and a whole lot of discounting.
Okay, GGB out of the chat here wants to know if you've been doing any secret investigations lately in any stores, and if so, which one?
Well, I wouldn't say secret investigations. A lot of things that we do are really spending a lot of time in the stores, seeing things and taking photos, buying videos, trying to bring a different type of analysis than anybody else around. And I think what you're seeing from Sears today, from the core operations, reflects what we've seen: high levels of clearance merchandise, lots of liquidation sales across the country, stores that just don't look right. But coming in for broader retailer, what we've seen over the past 2-3 weeks is just high levels of clearance coming out of the third quarter into the holiday season. You see a Walmart betting, I think, too aggressively for a robust holiday season within its stores. And I think ultimately everything we have seen, clearance levels, discounting, reflects what we've heard from JCPenney, Walmart, Kohl's in the past couple of weeks, where they've warned on sales and profits.
Okay, and just real quick before we let you go, your outlook for the holiday season.
I think it's going to be very competitive, which is normally the case. But I think if you're a retailer and you have things that the customer wants, you'll be able to sell full price. That's why we're more keen on, let's say, a Nike, an Under Armour, even a Foot Locker. I know stock came down this week on news the CEO is departing, but if you look at Foot Locker, they're benefiting from all the massive innovation that Nike and Under Armour bring to market, and their stores are structurally, in my opinion, better laid out than, let's say, competitors' Finish Line and Foot Action.
Okay, so a major short squeeze going on here in Sears Holdings, coming up on the $46 level, trading up 3.25. Not really making a believer out of Mr. Sozzi here. Hey, thanks for coming on at the last second. Always enjoy your commentary, and we hope to get you on the show again here. Maybe we'll get you on before the Christmas season, and we can delve into some of the other retail stocks.
Happy to help. Have a great weekend, guys.